account. So this is the second half of the equation, the sacred account. So the sacred account I'm going to show you is why we want to pair this up with our investments. Okay, if you guys aren't familiar, the sacred account, it's a high early cash value, dividend paying whole life insurance policy. And the purpose of this is actually to enhance investments that already work. So it's not going to be, you'll hear me talk about tonight, it's not going to be a silver bullet. It's not something that you do all by itself. You pair it up with smart investments. When I pair my sacred account up with a smart investment, it's going to actually enhance and make things even better for me, right? So check this out. First thing I'm going to do is go over the facts with you. So investors who use their sacred account with their investments will always make more money than those who do not. And the reason that I say this is it's a fact. Okay, I'm going to kind of show you the math behind it. But if I'm putting money in a sacred account and then I'm doing investments with that sacred account versus somebody who's just doing the investment, I'm always going to come out ahead. And I'll show you how that works, and I'll show you how you can simply implement that system for yourself. And there's probably two groups watching right now. There's clients, people that already have a sacred account with me, and then there's people that don't currently have one. So if you have one, I want to really help you wrap your mind around, okay, what am I using this thing for? Okay, how do I implement it to where it makes me money on top of my money? If you aren't using a sacred account right now, it's either that you don't know about it or you know about it and you're skeptical. I want to really help you understand, if I don't know about it, what is it? If I do know about it, why would it be something that I want to do? Okay, why would I actually want to get involved with this thing, right? So that's the first fact. The second is that the sacred account itself only makes up about 30% of the overall strategy. So again, it's not going to be the silver bullet. It's not going to be the one thing that you do. It's going to be about 30% of the overall strategy, which means that your actual investment itself makes up the other 70% of what we're doing here. So if I'm doing the sacred account, I have to realize that this is a part. What's up, Jethro? This is a part, and it's going to help, but it's not the whole equation. Okay, the whole equation goes back to the previous slide of make good investment decisions. And if I make good investment decisions and I combine it with the sacred account, it's going to equal 100% of my pie, and I'm always going to make more money, right? So there's a scenario where I have a sacred account and I use it, but I make bad investment decisions. That means that I'm not going to come out ahead. Or the scenario where I make good investment decisions, but I don't have my sacred account, I'm also not going to come out ahead in that story either. The next fact here, the way that we're investing is going to be mimicking large corporations and banks. Okay. So I'm looking at, if I'm looking at wealth, there's two categories of wealth, by the way. There's like individual wealth, top 1%. Who's seen like the Forbes list? You guys have seen that before, where they show like the wealthiest people. Those are individuals, right? Now, who's not on the Forbes list? Corporations. That's the Fortune 500 list. So there's kind of two different lists. We're not necessarily like, and you have to realize there is some trickle over. We're not necessarily studying individuals and how they invest. We're studying corporations. How do banks do it? How do Fortune 500 companies do it? Now, it just so happens a lot of people at the top of the Forbes list, they run large corporations and banks. So there's going to be some overlap on these people they probably have the same personal strategies, but a lot of the great investing philosophies and strategies started with companies and started with banks, and they started hundreds of years ago. And if we stick in line with that stuff, that's really where we're going to see traction, because it has long-term success. Okay, and it doesn't mean don't follow individuals and don't listen to people. I'm a person, obviously you're listening to me, but I'm saying we want to go back to where did this data originate from? The stuff I'm sharing with you, it's not stuff I came up with. It's stuff that I studied. What do these large corporations in the top 1% do? Next fact. This heavily relies on arbitrage. If you missed our arbitrage course a couple months back, arbitrage is when we take advantage of a simultaneous spread and maybe a profit margin or an interest rate. So really the factor that we're dealing with is we're going to take advantage of the fact that we can make money here on my sacred account, and I can make money here on my real estate or on my business or on my oil and gas deal or whatever it is that we're going to invest in, but it's going to be heavily reliant on arbitrage. That's the main thing that makes this work. And then next, we are also harnessing the power of tax-free accessibility in our favor. Okay, and I didn't say tax-free growth, I said tax-free accessibility. Okay, the way that you can get tax-free growth is you can stick money in an IRA. That's not what we're talking about. We want to actually be able to access the money too. It grows, we can also pull it. I don't want to just lock it up. It needs to be there for me, right? And then finally, guys, this is just numbers and math. So I'm not going to go over anything complicated today. I'm not going to go over anything that seems incredible, like you can't believe it. There are no silver bullets when it comes to investing. It's literally math. Okay, how do I make the math work in my favor? How do I get more math than less math? How do I get more math sooner and later? Like, it's just equations. And because it's just equations, this is the great thing. It's not science, it's math. Think about two different subjects in the room, Lexi and Jethro. Who did better at math versus science in school? You did okay at both? Yeah. Okay, Lexi?
I think I did better at science.
Science?
Yeah.
Okay, I always did better at math. Think about the difference though. Science, it's a lot more open-ended, right? People are always like proving and then reproving and then proving it that they thought what they thought was wrong, and there's new evidence. Math, it's pretty much always been the same. There's not a whole lot of new calculations in math because it's logics, right? Science, it's a lot of theory and abstract. So with this style of investing, we're dealing with logics and axioms. An axiom is a principle, it's a truth. So we're dealing with logics and axioms, and it's like a mathematical equation. It's not science. So there's not going to be a lot of theoretical, if this happens, then that might happen, or speculation is what we call that in the investing world. This is all math, and that makes it very good. If you're watching this and you're like me, I really like math. I wasn't always the best at it, but I've come to understand if you can get the equation down and you can understand why the math is the way it is, it's actually very easy to solve and handle. So when I first started learning about a lot of this stuff, it would go right over my head. I wouldn't get it. My eyes would glaze over. I would become disinterested. I would become bored. And what I realized was that I was overcomplicating the equation. So if at any point tonight you feel like you're getting lost, number one, let us know. You can drop in the comments. If you guys are in the studio, let us know verbally here. But number two, if you're feeling that way, realize I'm probably overcomplicating. I'm probably making it harder than it really is. So let's jump into some of the myths really quick. So the myths here, one of the number one myths, and this has to do with investing that I'm hearing, is investing is a passive activity. So I used to be a financial advisor, and what that meant is a client would come to me with their money, and they would basically say, here, Jerry, take my money and invest it for me. And I'm going to come back to you once a year until I'm 60, and I hope you did well with it. And that attitude is that investing is passive. I just give the money to somebody and they do the right things with it. And it's very hands-off. Okay, and I can see why that's attractive, because if I'm uneducated on something, I don't want to have to deal with it. I don't know anything about vehicles, so I really appreciate working with a mechanic. Okay, but the difference is that my vehicle is not detrimental to my financial success. I don't really need to know about vehicles. What I'm going to argue tonight is that I do need to know about investing. I do need to be able to be hands-on with investing. So that's one of the myths. The other myth is that the stock market is the place to invest. Who's heard that myth before? Okay, that's the main one we're purported, like go see a financial advisor. Someone texted me this week, by the way, and they said that their friend asked them to show them or introduce them to a financial advisor. I think it was at Lehman Brothers. And they didn't realize Lehman Brothers has been out of business since like 2008. And so there's a lot of just like mystique like around, stocks and Wall Street. And it's one of those things that it seems like the right thing to do. It's advertised, the branding is there, all the products are there. It's like Vegas, right? But we have to ask ourselves, is that really an effective place to invest? I'm going to talk about that today. The other myth is that life insurance is a bad place to invest. Who has heard that before? Yes. I used to actually think that. Okay, I was a Dave Ramsey guy for probably 4 years of my life, and I was like, never put money in life insurance. It's the devil. It's never going to make money for you. You're going to lose everything. It's a ripoff. And so I was really into basically the alternative, the market. Put money in the market instead. Don't put money in life insurance. Put it in the market. Okay, so that's a myth we're going to bust. Another one that is kind of the inverse of that is that all life insurance has its place with investing. It's almost like the pro life insurance. For those of you that didn't know, there's whole life insurance. There's 1 year term insurance. There's 5 year term insurance. There's 10 year term insurance, 15, 20, 30, 35. There's universal life insurance. There's index universal life insurance. There's variable universal life insurance. There's private placement life insurance. There's so many different types of life insurance. Okay. What we're going to talk about tonight is there's one specifically you need to know about. The other ones I don't think are good. I've never seen the math work on any of the other types of insurance. I've been in the industry a decade. So this is a myth that all life insurance is good. It's kind of the inverse of all life insurance is bad. We can't really make all statements like that. We can't say everything is good or everything is bad, especially in math. You can't say all numbers are this. What's the equation? What is the equation trying to solve for? And do the numbers we're talking about fit that equation? Okay, it's not an all-inclusive or all-exclusive. The other myth is that the strategy we're going to go over tonight is complicated. My bet is that at the end of tonight, you're going to be able to draw this on a napkin. And if you can't draw it on a napkin, don't do it. That's my investing philosophy. That was the number one rule I was taught, was if you can't draw it on the napkin, don't do it. It should be that simple. I can draw it, I can make sense of it, and it makes sense, and the math works too. And then next we have that the strategy we're going to go over is expensive. Okay, expensive is relative. It's really not that expensive. We're going to cover really what that looks like tonight as well. And then finally is that this is only for wealthy people. Okay, there's certain like financial instruments or ideas or concepts, and no one's ever told me this. I just started like buying into it at some point, that this is only for wealthy people, or I can't afford this, or this isn't for me. And no one ever came up to me and said, hey, Jerry, real estate's only for wealthy people. I started making those assumptions up on my own, which is really interesting. So if you're watching today and you're having those thoughts, I want you to start thinking about, when did I decide that? And is that correct data? Like, is that true? Okay, because what I'm going to argue here is that before wealthy people were wealthy, they weren't wealthy, and they use these strategies to get where they are. Therefore, it can't only be for wealthy people. They help people become wealthy, but it's not like you have to join the club in order to do this stuff. So here's some of the myths, and I know this is really small writing. I wanted to fit it all on the screen here, but I'm going to go through these one by one. So the first one is that investing is passive, and you should just hand it off, right? So historically, investing has never been passive. So think back, when you go back to like maybe 100 years ago, 200 years ago, before we were enamored with retail financial products, there were only a couple different investments you would do. You'd maybe invest in a business, or you would loan money to somebody, or you would buy land or real estate. There wasn't a whole bunch of other stuff. Now, if I'm investing in a business, that's not passive. I'm looking at their books, their numbers. I'm very involved. I want to make sure that things are happening in that business the way they need to produce. If I'm loaning money to somebody, same thing. I'm looking at, like, are they making their payments on time? Are they solvent? Like, it's not a super passive thing. I'm going to do some underwriting. And then finally, if I'm buying land or real estate, I need to know that as well. I was on a call with a client today talking real estate, and we're looking at, all right, well, what are the financial statements? What's the income? What are the expenses? Is it in a good area? Does the sale price make sense? Do you really want to pay real estate commissions if you don't have to? Like, it's not a passive thing. So the idea that you basically just hand your money over to somebody, it really was a lie that was purported by Wall Street. The only investments that seem passive are retail financial products. Okay, Wall Street invented those. You have to realize that those retail financial products, they were created by a board of directors. That means that a bunch of executives that are in business for the sole purpose of making profit for their company, they surveyed the market, they sat around, looked at data, and they decided, what financial product is Lexi most likely to buy? Okay, how do we need to advertise it? How are we going to distribute it to her? We need to make financial advisors so that these people don't feel like they're being pitched. They feel like they're being consulted with, so that they'll just give money to the product. Now, what advertising channels can we use that these people are watching so that they'll constantly see it and then want to start doing it, right? How can we get it into their workplaces? How can we get it into their churches, their schools? It's very well marketed when you think about it like that. So that's really from Wall Street. The other one is that the stock market is the way to go. Okay, the stock market, and I was actually shocked when I saw these numbers, which says a lot, because it takes a lot for me to be shocked about the stock market. So it's actually a terrible place to invest. When you adjust for true inflation, the Dow Jones has only earned a 1.7% annualized return since 1929. Who here thought it would have been higher? Like, annually since 1929, you would have guessed, because you hear, what do we hear? We hear 8s, we hear 10s, we hear 12s. When you adjust this for true inflation means the value of the dollar going down. It doesn't mean CPI. Okay, so the value of the dollar has gone down by about 95% since 1929. And 1929 is when the market crashed. So if I'm plotting a chart, by the way, and I'm just going to use my screen for this really quick. If I'm plotting a chart and I'm trying to make the numbers look good, I'm going to start at the low point. Does that make sense? So if I'm trying to pitch Jethro on the numbers, I'm going to show him here's from the low point, and that way I can show him only up. Right? So what's the lowest low point the market's ever had? The Great Depression. So we're starting at the low point, meaning we're giving the numbers an advantage. We're saying this is the lowest it's ever been. It's only ever been really up from there. But when we adjust for inflation, we've only seen a 1.7% annualized return. Okay, and that's not net of fees. That's the Dow minus inflation. Okay, fees, oftentimes, if you're in a 401k, your fees are about 1.5 to 1.75, maybe to 2.2%. So if I'm paying 1.5% in fees and I've inflation adjusted and I'm only actually getting 1.7, what am I really making on my money here? Nothing. I'm not making anything. See, this is the stuff people don't realize, and you're never going to hear about it because who is it that's pitching this? Wall Street. Wall Street doesn't want you to know that that's what's going on with the investments. So the idea that the stock market is the place to put your money, really, it's a myth, and this is the truth about that. The myth that life insurance is a bad place to put money. Here's the truth about that. The truth is that life insurance has been used as a wealth building vehicle since the 1800s. Okay, so it's literally been around longer than most of the places you put your money. It's been around longer than your mutual fund. It's been around longer than your bank. It's been around longer than your 401k. It's been around longer than the real estate that you're trying to buy. Okay, the only thing it hasn't been around longer than is precious metals, and then conceptually the idea of real estate investing, right? Real estate's always been a thing. Precious metals have always been a thing. So if I'm looking at stability, then I'm looking at this thing has been around longer than any of the stocks and all the garbage I'm investing in with my 401k right now. And it's been around almost as long as these guys. So for me personally, and I'm going to go ahead and let you in on this, these are my big three. Okay, I'm putting money in life insurance, precious metals, and real estate. I would say my fourth obviously is my business, but this is very stable, and you can go back and you can see the Rockefellers using it, and you can see Walt Disney used life insurance, J.C. Penney used life insurance. Have you guys heard of what's the chicken company? Is it Tyson or Foster Farms? Foster Farms used life insurance to get started. Tupperware used it. There's so many people that used it, and if you look back at that track record, you can see it's gone back so far that like it really stacks up well against any other asset class from a should I put money here standpoint. Is this a smart place? Because you're looking at what's the return, what's the risk, and if it's never lost money, that means the risk is zero. So if I'm comparing risk and return, the returns are going to be 6 to 8, the risk is 0. That's pretty good odds. Now, the other myth is that life insurance is always a good idea, and that there's all types and they all have a time and a place and a purpose. The concept that we're talking about tonight only works with one specific type. Okay, so this is like one type. We're going to call it mono life insurance, right? It's not IUL, it's not VUL, it's not UL, any of this garbage you see out there in the marketplace. It's one type of life insurance that actually works for this, and ironically, it's the same type that's been around this long. Okay, so if we're studying wealthy people, we're not looking at something that's only been around since the 1980s. We're looking at something that's been around for hundreds of years. Now, the next myth is that this is hard. The reality of that is if you can add, subtract, and look up definitions to words, then you can do this. Okay, so who in the room can add? All of us who can subtract? Who can look up words? Okay, so we're good. This is honestly, guys, if you're watching this like from a real standpoint, this is the one most people don't do. Think about when you were in school, when was the last time somebody told you to go look up a word in a dictionary? I don't think I ever had a teacher tell me to do that. So if I'm learning about finances, and if I'm brand new at this, and I'm not used to the vernaculars and the terms and all the vocabulary, and I'm not in the habit of looking words up, what's going to happen is I'm going to hear a concept, misunderstand it, or not understand it at all, and then quit. Oh, that's too hard. Oh, that doesn't make sense. I can't get that. That's way more than I can handle. When really what I need to do is I need to go look that word up in the dictionary, find out what it means, and then I can go reapply it to the concept. Now it makes sense, right? So that's what I want to encourage you to do. The other thing that we're going to bust is that the strategy here is expensive. This is actually one of the most cost-effective strategies out there because it makes you money. So if it makes you more than it costs, it's free. It can't be expensive if it's free. If it makes you more than it costs, it's free. And then finally is that this is not only for the wealthy. Like I said on the last page here, it's used by the wealthy. It got them there, but it's not something they had to wait till they were, a 1%er before they were allowed to get involved in. So I want to encourage you, again, break out of that mindset. Okay. So here's what we're talking about. We're talking about investing with the sacred account versus investing without the sacred account. This is, by the way, a real client case file that we're working on right now. So these are real numbers. I'm going to show you exactly how this plays out. So this client has $70,000 lump sum, and then they have about $840 a month that they're investing into a qualified plan. So a qualified plan is going to be like an IRA, 401k. In this case, it's a 401k. Okay, so they have 70 grand and $840 a month that they have going on inside this qualified plan. So this client is investing those funds into an asset that currently is going to pay him an 8.5% fixed annual return. He can reinvest every $50,000. Okay, so that's the term of the deal. Real asset pays 8.5% annually. That pays out to him as monthly cash flow. And then he can reinvest that every 50,000. He can go do another one of those deals. So it compounds basically every time he gets 50 grand. Without the sacred account, these funds would grow to $803,000 over the next 20 years. So what we're saying is that this guy, if he just keeps the 70K in there, 8.5% a year, puts his 840 and just stacks and saves until he's got another 50, then he rolls it over into that account again, does that deal, and continues doing that over and over and over for the next 20 years. That's going to amass a account balance for him of 803,365. Okay, not bad, right? Who would like to have $800,000? Yep. Right, pretty good sum. With the sacred account, though, check this out. If he does the same exact thing, the only thing he does differently is do the sacred account, he would have $1 million. He's not putting extra money in. He's not doing a different deal. He's literally just tagging it to his sacred account first, then doing this deal, and then filtering all the money through that sacred account. His account value would be $1,069,698 over 20 years. Isn't that incredible? Mm-hmm. And so what we're looking at here, let me grab some water really quick. So what we're looking at here is basically the strategy. I'm going to break down what we did here. So baseline is he's got this deal, right? Like we talked about, you need to have a good investment first. And you need to have money for that investment. So he has a good investment. He has money for the investment. Okay, by putting it in the sacred account, what's happening is it goes into the account. And like we've talked about before, that account starts earning dividends, right? So when he puts that money in the account, that 70K goes into his sacred account and it starts earning dividends. Okay, now he's going to take that same money, borrow it from the sacred account, and now put it into this deal. So now he is earning dividends and he's earning that 8.5%. The interest he's getting at that 8.5%, he's going to take that, he's going to repay his account. And every time he has 50K again in the sacred account, he's going to borrow against it again and do another one of these. And he'll continue to do that over and over and over and over again. And at the end of the game, he amasses on $1 million instead of 803,000. Okay, who would like to have an extra 200 grand just because you did something that way instead? Okay, was that complicated? No. Was that expensive? No, it's actually better than free. How's that at 1.44%? An additional. So his actual growth is higher. This is saying that this over 20 years, it's like earning so if he's earning 8.5, it's more like he's earning 9.94. Yeah, that's about right. 1.44 of the difference.
Okay.
Yeah, over 20 years. So it's kind of like having an additional 1.5% on top of his 8.5% every single year. Yeah, throughout the deal. So if you stack them annually, exactly. So that's a annual growth rate. So basically what he's doing is because, and Jethro kind of pointed this out, because he's doing this strategy, he's basically making an additional 1.44% on his money every year, in addition to that 8.5% he's already making. Right now, can you see, like I said in the beginning, like that is not the whole strategy, right? This deal is the engine. That's where the money is going to be growing from. You do need to be making smart investments. This deal combined with the sacred account produces an extra $200,000 for this guy. Right? So we don't just do the sacred account. We do the sacred account and we invest. We don't just invest, we invest and we do the sacred account. And it takes a lot of upfront planning, but after you do this guy, he's pretty relaxed with it. Like for him, this looks like he signs the docs, transfers the money pays to his account every month, and then he moves that into the sacred account. And then when he sees he's got 50 grand, he pulls it out and does it again. So he's not like super active. When you think passive income, this is about as passive as it gets while still maintaining control. Okay, so just from a numbers standpoint, that's the difference that we're looking at, right? Now the breakdown. So here's how we put this together. So this client dropped a lump sum of 70K into the sacred account. Okay, he followed that up with premium payments of $840 a month. So that means that every month he's putting $840 in addition to the 70,000 lump sum that he did. As soon as that 70 went in, he immediately took a maximum loan out of the account. So off of the 70, he was allowed to pull 62,047 against his sacred account and go invest that in the deal that's making him 8.5%. Okay. So there's a slight loss in liquidity here. Now I want to point this out. A lot of people, when they see the sacred account and they're like, man, this looks awesome. I've seen some people that are more short-sighted. So they look at it and they're like, what happened to my 8 grand? And they don't, and there's mechanics on where that goes. That's buying dividend, or that's buying dividend producing shares on your death benefit. But the bottom line is not where did my 8 grand go? The bottom line is what are you going to do with an extra $200,000? Right. So that's what we're looking at. This is a very long-term mindset. So he invested into that deal. The cash flow received from the deal each month went back into the sacred account loan. This is important. If you're in accumulation mode where you're not drawing income from this yet, it goes right back to the account. Okay, again, like we talked about this last week, you have to have the mindset of I'm a bank. I have to think with that. I'm a bank. If I'm a bank, that means that if I take money here and move it over, I have to pay myself back. If I lend money to somebody to invest, they need to pay me back every time they get paid. So I'm thinking like a banker, and I'm realizing that, yeah, I have the money here, but I'm not using this money. Okay, I met with someone about a year ago, and they didn't get this quite right away. I showed them this, and then they're like, cool, so I'm gonna have passive income. What can I do with it? And I was like, well, you're gonna pay your account back. And he was kind of like, wait, so I can't go play? And I was like, all right, bro, first of all, 8.5% off of 70 grand, that's maybe, what is that, $500 a month? Right? So he's got about $500 a month in passive income. That's not enough money to go play with. Right? So you're not even in the numerical phase of I've got enough passive income to go have fun. I'm still in accumulation mode. So I have to look at that too. If I'm still in accumulation, then I'm not going to play with the passive income. I'm just going to act like it doesn't exist, and I'm going to keep stacking it up. Right? Now, this $840 a month keeps getting stacked up until he gets to 50K. And again, at that point, he reinvests. This is different than like a stock market deal or a mutual fund. You guys have heard of the phrase compounding interest. Yes. So this compounds every 50,000, meaning that until you have 50,000, you can't put more money into the real estate. You can put more money into the sacred account, but you can't put more money into the real estate. Most real estate deals, they're not going to take $840 from you. So you have to think about like in terms of like units, right? So if I'm buying, let's say I'm buying an apartment complex, per unit, it might cost like $70,000. Look, if I divide the purchase price by the amount of units, let's say the average is 70,000. That's generally where they get their account minimums from. How much is it per unit? If I'm doing mobile homes, a unit might be 30,000 or 50,000. Right? If I'm buying single family homes, a unit might be 180,000 You know, if I'm doing a down payment, it might be like 20 or 30,000. So I have to think about like, what's my metric for compounding? Because it's not a mutual fund where every day my money gets reinvested at net asset value back into the fund. It's this money is going to chill on the sidelines until it's ready for the next deal. And a lot of investors, they actually get stuck and slow down here because they're not using the sacred account. That $840 a month just stays in cash. So it just sits there, it doesn't grow for them. So by putting that $840 back to work, it's at least going to get dividends. At least it's going to build up with your account so that when you have the next chunk, you have the continued, future growth, but you also grew it in the past. And it's going to give you that slight edge. So we're, again, if we go back, we're winning by an additional 1.44%. This is not doubling your money next year. Like I said, it's not a silver bullet. It's a drip. It's math. Every single time we get that drip and it builds and builds and builds, that's actually a decent number though. $250,000 off a little drip because I structured things a little bit differently. I would take that all the time. Now, what did we use in this? With this particular client, the first thing we did is we used something called a 401k pension trust. So you guys have all heard of a 401k plan, right? You go to a job, they offer a 401k or they offer a 403b. This is not very well known, and a lot of financial advisors don't even know this. The 401k is not actually a thing. It's an internal revenue code. So people think the 401k, they think of it as like, this is the 401k is the bottle in which my water is held, right? I put my stuff inside the 401k. The 401k is actually a tax code. If we're using the example of my bottle, the water is the investment. The bottle is actually a trust. So it's not actually like the 401k is just the classification in which we're going to build the trust under. And that's what makes it tax deferred or tax advantaged. Okay. So if you're thinking like, all right, I'm putting money in my 401k, technically, yeah, you could say that. People know what you mean and it makes sense to them. But in real life, you're putting your money into a trust that's classified under a section 401k of the Internal Revenue Code so that it obeys the IRS law to be able to get the tax deferral. Okay, so with that being said, if a 401k is not a real thing, that means that that thing you have at work controlled by Fidelity or American Funds or whoever, that's only a trust. All that is a trust. And because it's just a trust, they're the trustee. Okay, so a trustee means that they run it. They're in control of what you are allowed to do and what you're not allowed to do, including what investments you're allowed to put your money into. So if you're tracking with me here, if this is a trust and I don't like the investments offered by my trustee, I could fire my trustee. Simple logic, right? If I fire my trustee, I'm going to name myself as trustee. If I name myself as trustee, I can invest in whatever the heck I want to, as long as it's not illegal. Most people have no idea you can do that. Okay, Lexi, you just got off a call with who did you talk to this week that's in the industry that had no idea what you were talking about?
Well, there's two main companies, a representative from Wells Fargo.
Okay.
And then there was one from E-Trade, so another big company. And then last week I actually spoke with somebody from Schwab, who also had no idea what I was talking about.
And these are not like Indian call center people. These are financial advisors and specialists, right?
Right.
Okay. So she called Wells Fargo to help a client transfer one of these. She called Charles Schwab to help a client transfer one of these. And she called E-Trade to help a client transfer one of these. They had no idea that a 401k is really just a pension trust and that they were being fired as trustee and the client was going to become their own trustee. She actually had Wells Fargo hang up on her. Okay. So we basically helped this client move their money into a different pension trust, a pension trust in which he's the trustee and he's allowed to pick what he wants to pick, meaning he can do a sacred account and he can do real estate and he can do all this other stuff. You're allowed to.
But aren't you limited in whatever you can invest in?
Only by the trustee.
By the trustee, which is not you, I guess.
Right. So a lot of times the trustee is whoever sponsored the plan. So it would be like the Fidelity or American Funds or Charles Schwab. And they're only going to let you do what makes the money.
Kind of like the IRA, yes.
Yeah. Okay. So they're going to give you a list of like approved funds. And those just happen to be ones that they make fees on. And so if you take it out of their control, then you can basically massively improve and increase what you're allowed to invest in. So we have clients that they'll move their 401k over to us. We have a guy right now, he's buying gold and silver bullion, like physical rounds in his 401k. Like, think about, would you rather have a bunch of digital crap on a screen that goes up and down and you don't actually have anything, or would you rather have tangible assets? We have clients doing private lending deals. We have clients buying real estate. We have clients putting their money into sacred accounts, stuff they're allowed to do with their 401k, just their custodian and their trustee doesn't allow them to because that person doesn't make money on it. So we just fire the custodian. So we did that. Next, we set up a high early cash value dividend paying whole life insurance policy. I know that's a mouthful. I'm going to say it again. A high early cash value dividend paying whole life insurance policy. This is the only type of life insurance that works for this strategy. It's not going to be an index universal life policy. It's not variable. It's not a UL. You only want this. Okay, if it's anything other than this, just scrap it. Like, it's not going to work. So we set that up. And we made sure that that was pension series, meaning it was allowed to be inside of a 401k pension trust. We used Guardian Life Insurance in particular to set the account up because they sponsor these very well. And this is part of, by the way, when you're working on the sacred account component, this is the difference between working with an agent and a specialist. An agent's just going to give you the cookie cutter. The specialist is going to look at, okay, well, we're doing this. We want this. That means that we need to find somebody who does this. And these guys do it the best. Therefore, we're going to select them. Not, I work for New York Life and that's the only thing I can sell you. So I have to make sure that that makes sense to you. Right? So you really want a specialist. So once we got that set up, we funded the life insurance. We then put the money from the life insurance into the private real estate deal that pays him 8.5% on that deal. And he's now getting paid monthly cash flow for the next 60 months. So it's a 60-month term on that deal. 5 years, he gets his balloon payment back of the 70K. He can then go reinvest it again. Plus, he's got his accrued interest and all the money inside the sacred account. You guys tracking so far?
Now, is that liquid money that we're talking about?
Inside the real estate deal?
Yeah.
So the money inside the real estate deal is not. Once he puts it into the real estate deal, that money is like locked up in that deal until the term is done.
Once it's done,
then it's liquid. So it'll come back to him. So that's a good question. So if he puts 70 in, that means that for 60 months, he can't take that 70 out. He can get the cash flow, right? So it's going to pay him every month. But at the end of 60 months, they're going to return that 70K back to him. And he'll have his 70K liquid again. Plus, he's got all the accrued interest or cash flow payments that he received every month for 60 months. Okay, so that's kind of how that works. Now, the next thing we did on here is we set up a pension trust checking account with a bank. Now, again, most banks don't even know this is a thing. Lexi, how many times have you had a client go to a bank and the bank had no idea what we were talking about?
I can't even count.
All too regularly.
So many times.
And do you know what the bank's going to do? If I go into a bank wanting to set up this and I tell them this is what I want to set up, they're going to get confused, but they're going to hear 401k. And then they're going to say, hey, Jethro, why don't you talk to our bank's financial advisor? And then what's the bank's financial advisor probably going to try and sell you, Jethro? 401k, more mutual funds. He's going to be like, here, let me show you the growth fund of America. So you want to set this up with a bank that knows what you're talking about. We have several banks that this is basically all they do. So when we send them business, they don't interfere with it. They don't screw it up. They just set up the pension account like we need it to. So we set up a pension account, and then we also set up an escrow account with a local bank. So when these payments come in, they pay into his account. And when they pay into his account, they're being paid from an escrow. So that real estate deal that's paying him, we don't want it to be buddy to buddy handshake. The guy pays him under the table. We want the investor that's borrowing the money from my client to pay that cash flow to escrow. Escrow is a third party. Escrow is going to make sure that the money gets collected the way that it was supposed to and delivered the way that it was supposed to. This way, there's no room for error. Because if this is just, I tell Jethro I'm going to borrow this much money from and I'm going to pay him every month and there's no regulation, there's a higher chance that I don't pay Jethro or I start paying him in unequal amounts. Jethro might be really busy and he might never check until 6 months down the road. And he's like, hey, Jerry, what the heck? You said it was going to be this and it's not, but Jerry's nowhere to be found. So escrow regulates all that stuff, right? So I'm looking at escrow. We set that up for the client. And then obviously the other thing we used was money. This client, and I hate to be this guy, but this client had money. That's your responsibility. You have to have money. If you bring money to the table, we can put all this together for you. Okay, and it doesn't even have to be in a 401k. This could be done with regular savings. This could be done with equity from your home. This could be done in several different ways, but you have to have money to do this stuff. So this is all the tools and everything we put together for this client. Now, the big three here that you need to have to make this sacred account investing strategy work. Number one, you have to have funding. Okay, this can be savings. It can be a retirement plan. It could be home equity. It could be money you borrowed. And by the way, if you borrowed money, make sure that it's not a variable rate that's going to jack up on you, like a credit card. Make sure that it's going to be something that you're going to earn more than it costs, and make sure that you actually have the deal before you borrow the money. Okay, because if I borrow money and I don't have the deal, I can get stuck like holding that money and paying interest and not making cash flow on it. Then the second thing you need to have is you need to have a cash flowing investment. So this could be real estate lending, notes, oil and gas, private equity. We'll talk more about that. Third thing we need to have is a sacred account. Okay, and again, it needs to be high early cash value, dividend paying whole life insurance. I'm going to say it again, not index universal life insurance, not variable universal life insurance, not universal life insurance, not term insurance, not regular whole life insurance without cash value. It's a very specific kind. Okay, so we have to make sure that that's in place. I did put a note here. So this strategy does not work with index universal, all that stuff I just said. It's basically, this doesn't work with retail financial products. Okay, this can't be like a retail financial product. This can't be a retail financial product. Obviously, your savings or funding could come from anywhere, but you can't take, like, you wouldn't be able to take this, stick it in a sacred account, and then go invest it in mutual funds and actually make money. Because we just looked at the stock market paid 1.7%. You'd be losing. All right, so mistakes to avoid. Here's the pitfalls. If you are doing this, you do need to be, how do I word this? It's not fearful, but you need to be aware of your risks. You need to be aware of your risks. And based on your risks, and this is actually how I do it, guys. I list out what is every single thing that could go wrong with this investment before I put my money into it. That's like, if I do 3 columns, that's one column. The second column is what is every single thing I'm responsible for doing to make sure those things don't go wrong. And then the third column is what would happen if they did go wrong. Okay, so I'm looking at what are all the risks, what is everything I need to do to mitigate the risk, and if the risk does happen, and I try to, but if it happens anyways, and even though I try to prevent it, do I still want the investment? So I'm looking at 2 things. Do I want to actually do everything that's required to make this thing work? And if it doesn't work, do I still want it? If I can't answer yes to both of those things, I'm not doing the investment. So that's what I mean by having a sure thing. Technically, nothing is guaranteed. But if I confront all the risks and I look at how am I going to have to handle these, do I really want to do all that stuff? And if it goes south anyways, do I still want to be involved? If I can't say yes, then it's not a sure thing deal. You have to have that. So if you don't have that, what can happen is you can get involved in the investment and then it goes south on you and doesn't pan out. And then you're stuck holding the bag on, I've got this sacred account, but I don't have the other equation. And if I don't have the other equation, it doesn't mean that that means that I don't have the other 70%. Like we said, the sacred account is only 30% of the strategy. Okay. The other one that we see all the time is wrong policy design. Okay. I've seen this so many times, especially in the last year. I say, hey, I want life insurance. Every snake oilsy salesman person you know is like, oh, Jethro, let me help you with that. And guess what? None of them know how to design it properly. Okay, I have agents that work for other companies that come to me for their policy design because they don't know how to do it. And the other company is not going to do it the right way because they lose so much money by doing it that way. Like we have, like that happens like on almost a regular basis. We'll have an agent from another agency be like, hey, I want to set up a sacred account with you guys. So think about it. If they work there and they're worried about having their policy designed incorrectly and they work there, as a consumer, how much more aware do I need to be? Okay, the other one is being disorganized. Being disorganized means that I'm not tracking my payments. I don't have an escrow set up. I'm not looking at my books. I'm not paying attention to taxes. I'm not paying attention to where my funds are going and if they're being commingled or not. Like being disorganized can cost you a lot of money unintentionally. So you want to make sure you're organized. And this is part of what we help you with. The other one that we can make is not paying your policy loans back with your cash flow. So again, I hit this already, but we talked about you have the policy loan out it gets invested. You're now getting cash flow. We don't keep the cash flow. We pay it back to our bank, which is you. Okay. The other mistake we can make is being short-sighted. Being short-sighted means that I'm worried about, on that first slide, the $8,000 in liquidity that I'm going to lose in year one, instead of looking at the $260,000 I'm going to gain as a result of the strategy. Okay, like being short-sighted, basically, and this is my experience, the only times I've ever been short-sighted was when I was broke. And if I'm broke, I have to look at that as evidence that I don't know what I'm doing financially. Because if I did, I wouldn't be broke. So if I'm not doing well financially and I'm broke, it means I don't know what I'm doing, which means I shouldn't take my advice. In a nutshell, if I'm being short-sighted, I shouldn't listen to myself. I need to look at what actually works. Not what am I doing and what do I think? Because what I'm doing, what I think doesn't work, what actually works. The other mistake we can make is investing in deals that don't pay or are speculation based. So you're not doing marijuana farms, you're not doing Bitcoin, you're really focusing on cash flow. It has to cash flow. That's why I like private lending so much. And then the next mistake we can make is borrowing money to fund the strategy that costs more than we'll make. So I would not borrow money on a credit card at 12% to invest in my sacred account to then go do a deal that makes 8.5%. You guys see why that wouldn't work? I would be negative. Okay, those are the main mistakes. You do not want to do these. And this is like part of what we cover when our clients do these deals. We're on the phone with them. Okay, we're helping them go through the transaction. We're advising them. We're looking at the numbers. We're making sure it all makes sense. So that way they don't make these mistakes. So, and I want to give you a couple of fun examples. Who here, are you guys familiar with oil and gas investing? Have we talked about that at all before?
We did a little bit.
So check this out. This one is just for fun. This is a client, they invest $75K in an oil and gas deal for 20 years, periodically reinvesting, again, every time they have $75K built up. So without doing a sacred account, that oil and gas deal is going to grow their money to about $881,000. Okay, with the sacred account, that oil and gas deal is going to grow to $939,000 in the same time frame. Now check this out. The oil and gas deal allows him to deduct his principal investment from his taxes the year he invests. Okay, not defer. It's not a 401k where we put it in and then we pay penalties or take it out when we're 60. I'm saying, imagine being able to buy real estate and all of the money you put in the real estate, you could deduct that year from your income. How much money would you put in real estate if you could do this? So this is cash flowing asset, not in a 401k, not locked up, pays him every single month. He deducts $75K off his income as soon as it goes into the deal. So again, we're reinvesting every $75K for 20 years, periodically reinvesting. That means that reinvesting $75K, we're going to be able to do that 9 times throughout the deal. 9 times that we're going to reinvest. 75K rolls over just from accrued interest. So that means that he's going to write off $675,000 off of his income over the next 20 years. That's 75 times 9. $675,000 off of his income in the next 20 years. If he's in a 20% net effective tax bracket, this means that he saved $135,000 in taxes. And this is not even including the sacred account on top of the $881 he made, right? So he does this over 20 years. If he were to put this money in a sacred account, that 135 would actually be worth 179 because he's putting his tax saving into the sacred account. And the entire time it's growing. So if he does this deal without the sacred account, he would make $1,016,000. If he does it with the sacred account, he'd make $1.1 million. Right? Basically, same exact deal, but he's taking his money first, putting that into the sacred account. Second, the money he's saving on taxes, he's putting into the sacred account as well. And that's what he has to show for it instead. So again, this is based on a really, really good deal being paired up with the sacred account and consistently borrowing, repaying, and doing that throughout that time period. Okay. So really quick, guys, I want to hit what types of investments are best for this. One of the main ones is going to be real estate. And the reason why is cash flow is involved. You do have depreciation, you do have growth, you have leverage, you have debt pay down. Those are all advantages of real estate. Okay. Primarily though, it has to cash flow. So this is not like if I'm in Anchorage, I'm probably not buying a fourplex with my sacred account. Why? Because it doesn't cash flow. So I'm going to look at what actually pays me every month. Private lending. Again, I like that because it cash flows, it has collateral, and I like this one the most because it has predictable income. I know for a fact I'm going to get paid the same thing every single month. I don't have to worry about tenant issues. I don't have to worry about it's just put the money in the deal. I loaned it. They're paying me interest every month. Mortgage notes are much the same. Oil and gas, I like those. We just talked about that. You have cash flow, tax deductions before and during, and then you have capital gains after. And then the last one you can do, which is a little more risky, is small business private equity. If you invest in the right company, you could have cash flow. Okay, if you invest in the wrong company, you could have nothing, right? So your risk tolerance is really involved here. But if everything goes right, I have cash flow, growth, tax benefits, and I have capital gains. Okay. Now, as far as funding is concerned, where are the best places to get money? One of my favorite things to do is I like to look for where do you already have money? How can we reposition it to where you're accelerating something that's already there rather than start from zero and build it up? So if you already have an old 401k, that's an immediate resource we can use to push into the sacred account and then to push into your cash flowing deal. Same thing with an old IRA. If you have an old pension, a lot of people don't realize this. You don't have to wait for the income. If you've left that job, instead of waiting till they pay you at 65, you could just request a lump sum payout. So they'd pay you out today. You could pull that money out and then go do this with it. Savings is good. Current life insurance cash value. So if you have life insurance, I'm working on a client right now where he has 50 grand, but it's in the wrong type of policy. It's in universal life insurance. So we're going to roll that into a dividend paying whole life insurance policy with higher the cash value. He'll be able to utilize this. The other one is home equity. If you have home equity, there's no reason it should be sitting there. It's doing nothing for you. So if you have enough home equity, you could do like a home equity line of credit, first position preferably, borrow that money out at 4 or 5%, and then go make 8, 10, or 12% with it. And then last one is if you have college funds. So if you have a 529, a Coverdell, an UGMA, an UTMA, whatever you might have out there, we can also reposition that as well. So these are the best places to get money. And then I'm going to hit real quick the companies you should be working with. So if you're looking at what companies do I go with, the big three that we like are Guardian, Mass Mutual, and New York Life. Each of these have different advantages and disadvantages. Guardian is going to be a little more flexible, but they do pay a little bit lower of a dividend. Mass Mutual, they're higher dividend, but they're less flexible and they require more money to get involved. And then same thing with New York Life. They're more flexible, less flexible, but they do pay a higher dividend. They cost more to get involved. They do have probably the best financial strength. So if you're really looking at stability, that's a good way to go. And then really quick, I want to do our leading by example. So this week, I want to highlight a client of mine. His name is Mike. And Mike has been one of my very first clients. When I first started in the industry, Mike was somebody that I actually started working with several years back. And so Mike is someone that actually is doing this exact concept with us in several different areas. Okay, so one of the main things we're working with Mike on is 401k banking, where we are setting up his 401k inside of a trust, putting it into a sacred account, and then investing that, right? And he's getting that interest on it. But what Mike said here, which was really cool, he said, through my association with Jerry and the team at Wealth DynamX, I've been able to create a personal plan of asset-based investing for my wife and I. I now educate myself extensively on the sacred account, the economy, and lots of other topics that have always interested me, but I never knew where to get the information. You just don't know what you don't know. Jerry and Wealth DynamX do, though, and they're happy to explain things in easy to understand terms. So really kind of what I liked about Mike's story is A, he's doing this, but B, like he mentioned in the story, if you're like him and probably like me, like at some point, this stuff was of interest to you. And a lot of people don't know where to go to get the information. You go sit down with the financial advisor. He's not sharing this with you. The banker is not sharing this with you. Your realtor is not sharing this with you. Yeah, they might be good at their job and good resources, but what Mike found with us is we're really somebody that sat down and said, hey, this is all that stuff you're interested in. This is how you do it. This is actually how you make it happen and how you implement it. Okay, so again, the question becomes, do you want to invest with the sacred account or without the sacred account? We've hit plenty of these, but real quick recap, and this is just showing 30K. 30,000 invested for 30 years at 12% interest. With the sacred account, $614,000 is what it grows to. Without the sacred account, it grows to $415,000. So my question to you is not, are you doing a sacred account? It's what are you going to do with the extra $200,000? So guys, really quick action steps. Then I want to open this up for questions. If you're watching today and you're like, man, this is interesting and I want to learn more about it, your first step is probably to meet with Wealth Dynamics, meet with my team and review your situation. You might be in a position right now to do this and you didn't even know about it till we start looking at your numbers, or we might need to do some work to get you up to the point where you can invest. Okay, that's where I started. I wasn't instantly like, I wasn't 40 years old with a 401k that I had from my old job that I could invest. I was 20 something, building up my savings and trying to figure out how to make this happen. We can help you either way. Determine where your funding will come from. That's step number 2. Is it retirement? Is it cash? Is it savings? Is it home equity? And then actually fund your account. Start that game, get it going with whatever that might look like. Then we invest for cash flow. That's going to be a process of looking at deals, running numbers, finding the one that makes sense, and then finally work the system. Continue committing and going back and forth with that borrow, repay, and just continually building that thing up until you are ready to live off the passive income. So guys, that's all I have for you tonight. I do want to open this up for a couple minutes to have questions answered. So do we have any in the room in the studio tonight or anything online?
Online, Jerry, can you go over the types of investments that we can get into other than real estate?
Yes. So let me go back really quick. Who was that, by the way?
Kerrigan.
Michael Kerrigan. What's up, Mike? So the investments we can do real estate. Okay. So other than real estate, we can do private lending. We can do mortgage notes. We can do oil and gas investing, and we can also do small business private equity. Okay. And there probably are a couple other ones. These are the main ones that work, though, the main ones we've worked with. So good question, Mike. Any other questions we have?
Yeah, from Nano, can you explain the relationship between a 401k being a trust and replacing the financial advisor so the owner becomes the trustee?
Yeah, so your 401k is just a tax code. So IRC means Internal Revenue Code. There's an Internal Revenue Code called Code 401k. 401k is not actually a financial vehicle. It's just a revenue code. So what companies do is they set up a pension trust and they set it up to where it meets the description of Internal Revenue Code 401k. Now, the company does not want to be responsible for your investments, so they select a trustee and custodian. Okay, the trustee and custodian is typically a Wall Street firm. So they're going to only provide you with options to invest in their company, in their products, because that's how they make money. Okay, so it has nothing to do with the 401k. It has everything to do with the fact that it's really just a trust. This is who the trustee is. They're at the driver's wheel. They're the one picking everything. They're going to give you things that only make them money. So if you want to fire them, first, you have to actually not be working for the company anymore. So you have to leave the job, retire. At that point, you can fire these guys and become your own trustee. By becoming your own trustee, you're allowed to invest in whatever the hell you want to, as long as it's not illegal. Okay, and that's where we come in. We're not your trustee, but we actually help you become your own trustee. So we set up your new trust. We do all of the documentation with the IRS, with your banks, with everything you're going to need to be able to run this thing. And then you become your own investment firm. And then we help you decide, does this make sense? Does it not make sense? Is it legal? Is it not legal? So that's kind of what that looks like. I hope that answers that question. Do we have any other ones?
Yeah, we got one more from Chris Hemingway. Does that real estate deal also pay profit out on the sale or refi?
I think Chris means the one back here. So Chris, on the one that we talked about, let me go back previously. If we were talking about the deal on the very beginning here, this one was private lending. So this one did not pay capital gains on the back end. This was a debt deal. So we basically loaned the 70K to the deal, locked in our interest rate, got paid every month, and then the deal pays back the principal. Okay. And the benefit there is you don't have any chance for loss and you're guaranteed to get your interest. If you want to go the other route, which is the private lender, which is the actual real estate, that's going to be right here. This stuff pays out capital gains on the back end, but it may not actually pay. So there's risk on I don't make anything versus private lending. I know what I'm going to make. I just know it's not going to be more than that.
We got one more from Todd Rugoli. To become your own 401k trustee, do you have to cash out the current plan with employer and pay taxes/fees? Does it have to be qualified plan from a previous employer for a rollover? I'm assuming you can't just transfer current funds from a qualified plan without some sort of penalty, as they would want to recoup their fees they've been missing out on.
That's a good question. Before I answer that, Todd, you are my boy. My love language is steak. And today Todd spoke my love language in a big way. So thank you for that, Todd. Merry Christmas. And to answer Todd's question, so it does have to be either a qualified plan or a traditional pre-tax IRA. It cannot be an active employer. So it has to be an old employer. As long as it meets those specifications, we can move it over with no taxes and no penalties. Okay. The other thing we can do is, if you don't mind paying taxes, we can, let me go back to the oil and gas here. We can cash it out and then put it into an oil and gas deal where you're going to write off the entire principal amount anyways. So let's say I had 200 grand and I did want to cash it out and my tax penalty was 30%. I would put it into an oil and gas deal and write the 200 grand off my income. So it shows that I didn't make anything. Then I'm basically canceling that out altogether. So there's ways to do it either way, but you are right. If it's an active employer where you work currently and it's a current like sponsored plan, they will have a penalty. Sometimes they won't even let you move it. The employer will have inside their adoption agreement that you can't touch that money till you leave. Okay. You can always borrow against it and do the 401k loan thing, but that's a lot different than actual rollover. So Todd, I hope that answers your question. And if you're interested in that, reach out. We can definitely go over the numbers. And thank you again for the steak.
I think that's it for
Any other questions? That's it?
Yep.
Cool. Jethro, did you have anything? Jethro is all good. Guys, thank you so much for watching. We're going to tune out here. Have a very Merry Christmas. We will be back again next week, and we're going to be talking about some more awesome and interesting investing stuff. But have a great weekend. Make sure you like, share, and subscribe. We'll talk to you next time.